Okay, folks, in this video, we're going to take a look at probably the worst investment Warren Buffett ever made. Today, we're talking about Kraft Heinz, a company Berkshire Hathaway bought a significant chunk of its equity. In its Q3 2025 reports, Berkshire stated they own more than 325 million shares, representing 3.17% of its total portfolio of listed stocks. Back in the time when Berkshire acquired a stake in Kraft Heinz, the company seemed to be significantly hurt and represented a good value investment. Typical of what Mr. Buffett used to do, buying strong brands with high recognition. An easy-to-understand business, not a tech company, but a food company that owns famous brands such as Capri Sun, Jell-O. The matter is, it appears to be one of the worst investing in Warren Buffett's career. The stock is moving sideways since 2019, ranging from $20 to $40 at best. But for the value investor, the main concern is not the price, it's the quality of the fundamentals. So let's drop by the quarterly report and see what we have here. In a 3-month period and 9-month period, the sales are going down. The main problem being this goodwill impairment, which shows Kraft Heinz was owning assets that were deeply overpriced in its balance sheet. When this occurs, the company has to recognize a loss that hurts the income statement, both reducing the profits. Indeed, they are negative for the 9 months of 2025, and the goodwill figure on the asset side of the balance sheet. It's like paying too much to buy a stake in whatever asset you're thinking. Great, I own a luxury car valued at 500 grand, then realizing a few months later you have been scammed, and the car is actually worth only 50 grand. You take a hit of 450,000 that will reduce the total value of everything you owned, your assets, and all the profit you may have this year because you overpaid for something in the past. And only now you realize it. But anyway, goodwill figures are not a cash expense, since you see a positive number added back in the cash flow statement. It's very important to know that accounting mechanism when you go over financial reports, 10K or 10Q. See, in terms of cash flow provided by activities, we have a huge $9 billion here as a compensation for the net loss of $6 billion we had before. Therefore, the business actually generated a little bit over $3 billion as at September 27th. Now take a look at the balance sheet. Let's go on the asset side. You see the value of the goodwill being slashed, losing around $7 billion here and again, $2.5 billion here. This is our goodwill impairment we saw, totaling more than $9 billion before. And this is actually the main concern for a value investor when considering Kraft Heinz. The company had made crazy expenses in the past to acquired brands. The company was growing externally. And these expenses are reflected in the goodwill figure and intangibles. It's kind of a black box. You can see it that way. It's very hard to understand what's inside of it. Did the company overpaid in the past for some assets? Did they burn cash? Maybe they could have had allocated the capital differently? Are they paying now for the bad decision they made before? These are questions we can't easily answer. But not only that, Kraft Heinz also carry a huge amount of debt, more than $19 billion on the liabilities side of the balance sheet. This is long-term debt. But you also need to take into consideration the short-term debt of $2 billion approximately. That's more than $21 billion in total. This is pretty much dangerous, especially if the shareholder equity is only twice as much, around $41 billion. And last but not least, Kraft Heinz is a no-growth company. Since 2016, the revenues did not improve and are stuck at $26 billion. The market saw that and punished the shares accordingly. For all these reasons, I would say this could be the worst investment of Warren Buffett. And you see, numbers don't lie. The company is heavily in debt. The sales are not increasing, we said. The goodwill is impaired, causing net losses. Therefore, Kraft Heinz cannot afford a bigger dividend year over year, and you get today, less than what you had in the past. This is $1.60 per share right now, giving you a juicy yield of 6.5%. It seems good on the surface, but it actually tells you how bad the stock price has been in recent years. Because as long as the stock is going down, the yield keep increasing, assuming the dividends stay constant. So, hope you like this format of video. Feel free to suggest a company. I'll look into it. And I'll come back soon with another analysis. Bye, guys.